Greetings, everyone. This is Kevin DeSano with Beacon Pointe. Welcome to our May 19th, 2022 Macro and Markets call. As always, I'm joined by our Chief Investment Officer, Michael Dow. Just a couple of housekeeping items. If you have questions, we will take questions through the Q&A box at the bottom of the Zoom window. So if you move your cursor over the window there, you'll see the Q&A box. You can absolutely type your question in. Questions will be coming in throughout the webinar today. Apologies if we don't have a chance to get to your questions typically during these, especially today. I have a feeling we're going to get a lot of questions, so we may not have time to get to every single one of them, but we'll certainly do our best to get to your questions during the course of the call today. On our call today, we're really going to be talking about what's going on in the macro environment, and then specifically how that relates to the overall markets, both the stock market and the bond market. And then Michael's going to talk about what that means in terms of portfolio and portfolio positioning. But before we start in the meat of the call today, we've talked a lot, Michael, about the idea of investors having a plan and sticking with a plan for exactly periods like this, periods of extreme market volatility, when things get very difficult. Can you talk a little bit about the idea of when clients come to us, we do a risk assessment, we talk to them about what their long-term goals are, their near-term goals, and then we position portfolios accordingly. Talk about the benefits of that, especially in these types of market environments.
Sure. Thanks, Kevin. And thanks, everyone, for joining the call today. We really appreciate you taking some time out and to listen to what we're seeing and how to maybe help navigate some of the difficult equity and bond market volatility we're seeing. To answer your question, Kevin, it's pretty straightforward. We're not managing for the shorter run, and most clients don't have effectively, they don't have short run liabilities that they're trying to match their assets to. That is, they've got a 10 or a 20-year investment horizon because they've got 10 years or more to retirement, or 20 or 30 years perhaps beyond retirement. So thinking about things and placing them in the context of the long run is absolutely key to try to become less affected by some of the wiggles that occur in the marketplace. I've got a nice chart in here I think people will appreciate. We're investing and we want clients to know that we're positioning portfolios for the trends and not for the shorter term volatility, which is completely unhedgeable and unknowable. We can't know when there's going to be a correction. We can position the portfolios to try to preserve capital when there's signs that suggest that we're heading towards a potentially more difficult market. For example, when the Federal Reserve takes their foot off the gas pedal. And that's exactly what today's conversation is about. Why are we here? Where's the potential bottom of the equity market? And what are the signs that we need to look for? But know that that's key when thinking about managing or portfolio construction. When we're putting a portfolio together, it's for the trend, not for the wiggles.
That's great. And for those of you that are just joining us, we were filling a little bit of time there at the beginning for folks to file in. I know it's difficult for everyone to sometimes get in right at the top of the hour. So now it's 3 after. We're going to get started in earnest. If you have questions, again, we will get to questions. Type them into the Q&A box at the very bottom of the Zoom window. Just scroll your cursor over there and you'll see a little Q&A box. You can type in your question there. Again, apologies if we don't have a chance to get to every single question. We'll try to group those questions and pose them to Michael throughout the course of the webinar today. So Michael, we've got a big audience and we've got a lot to talk about. So let's get started.
Okay, that sounds great. We've already got our first question from Neil Goldstein, who I think I'd be happy to address that one. Thanks, Neil. The answer, just really quickly before we jump right in, is that subprime was a much bigger problem. The question is, subprime caused the great financial crisis. Will crypto cause another? And I just actually read an article this morning. The destruction in crypto markets is cost about $1 trillion out of a $2.5 or $3 trillion market cap if you take all the cryptos together. And with household wealth close to 150 trillion and only a third of crypto assets here in the US, the losses here in the US for US investors in crypto are on the order of $500 billion, meaningful for sure, but not likely to derail the crisis. It's not widely enough owned, nor is it levered to the extent, not just here, but into this European banks, which caused the crisis. There's a really good question here, a really good point that I'll make a little bit later about the health of the financial system and the consumer, which is a couple of positives that we're gonna get into. The agenda today, Kevin, is, as you know, we're first going to start with the global growth outlook and review of the secular investment thesis that we've had and articulated at each of these calls for the last 2 years. That's financial repression. It's the policies that the government pursues to keep nominal interest rates low, and perhaps, if they can, engineer a little bit of inflation. We've got way too much inflation now, but a little bit of inflation is good to reduce debt levels and keep debt sustainability for the U.S. Treasury at a reasonable level. So financial repression we'll just touch on. We're moving from a discussion we had last fall called peaks now to something later into the cycle. In fact, we're probably in the later stages of the business cycle. So there are some dynamics related to the capital markets that need to be addressed. Again, we began talking about this 6 months ago. And set the portfolios up appropriately to deal with the current volatility and the late cycle dynamics, and we'll spend some time there. There's clearly market implications. The macro implications of late cycle dynamics are pretty straightforward. The market implications just make the late cycle the most challenging investment environment of any of the business cycle stages. So bottom line, what we're here to talk about is how to position a portfolio in the current environment, and not just to protect what we've got today, but to take advantage of any opportunities that we see going forward. So let me jump right in. First things first, let me just lay it out there, because this is really, I think, the best description of what's happened in the last 3 to 6 months, or at least the most concise. First, we're going to talk about the macro dynamics, and then we're going to talk about the current market dynamics. The macro dynamics are pretty straightforward. We have the highest inflation in 40 years, and frankly, the first negative GDP print since the second quarter of 2020. Coupling those together, you have a potential for a stagflationary environment. That's the definition of stagnant economy and inflationary environment. And we haven't seen anything quite like this in 40 or 50 years. And it's not, by the way, we're not going back to the 70s. If we do get about a stagflation, which we could be in right now by some measures, high inflation and low growth, or in the case of the first quarter advance print, we're going to get a couple more revisions of the first quarter GDP number. It may not be minus 1.4 when we're all done with it, but it'll probably be close to zero or below zero. And the combination of those two things, unfortunately, is forcing the Federal Reserve to act. They have a dual mandate. It's actually a mandate that is at cross purposes. The dual mandate is maximum employment or maximum activity, at maximum economic activity. Clearly, that's not happening. And stable prices, that's not happening either. Their number one priority right now is to regain control over prices. They're just too high, and they're going to start to affect how consumers and households and, frankly, businesses decide to invest. So higher prices are already beginning to bite the consumer. We've seen that recently, and I'll talk a little bit about some of the stocks that have gotten hit as a result of that. But mostly, the important thing to know is the Fed needs to act to control inflation, and that switch, when they flipped that switch a couple of months ago, is what's causing the increasing volatility in the equity market. And again, when interest rates go up, bond prices go down. It's the proximate cause of the massive underperformance in the bond market that we've seen. And first quarter and the first 4 months of this year, we'll see in some slides, very unusual, highly, just historic underperformance across capital markets. And unfortunately, a higher correlation amongst assets. You have a diversified portfolio of stocks and bonds, because when stocks zig, the hope is that the bonds zag. And that's a correlation argument that suggests that stocks and bonds are not perfectly correlated. They're not correlated, and in many cases they're negatively correlated, which is what you want. That's a positive thing. But you had positive correlation in capital markets in the first 4.5 months. It's starting to reverse now. In fact, there's a pretty meaningful reversion of that happening today. You've got stocks down a little bit and bond prices are up, which is what you're expecting in the normal environment. But for the first 3.5 months, 4 months of this year, We've had high correlations between stocks and bonds. They both went down at the same time, which is unusual, but it's all a function of the fact that the Federal Reserve was forced to act to address the inflationary environment. This is a great slide to put it in perspective. There's 42 years of data here, or year to date 2022. It just shows the S&P calendar year return and the worst drawdown during the year. So during calendar year 2022, for example, we're down 18% right now. And that happens about a third of the time. But 75% of the time, you still end up with a positive result for the year, for the calendar year. Now, some of this is timing. If you had a drawdown towards the end of the year, you're not going to get a positive calendar year. That's what, and that can occur. That's what happened in 2018, for example. All the damage was done in the fourth quarter. But the point is, you should expect to see a 17 to 20% drawdown. They're very common. 1 in 3 years. We just haven't had one. We've had these three great years from 2019 to 2021, and we should expect it. It was one of the theses we had last fall when we were preparing portfolios. You don't have equity prices just go straight to the moon without any kind of a reversal. So it was going to happen. It was inevitable. And we should expect it. We should always expect it, but we should also expect that over the long term, we're going to see positive returns. And this chart, I think, is helpful. Looking back about 80 years worth of history, this is the S&P 500 total return on a log scale. So it can get so you can put 80 years of data on one chart. It basically tells you if you're investing for a trend, you'll be in great shape. If you try and catch these wiggles or time the market or become overly concerned about shorter term market gyrations and decide to significantly change your asset allocation, that's generally a bad idea. It's generally a bad idea because there's no way to predict and you can't get back in at the right time. So staying fully invested in a portfolio that's consistent with your long-term risk profile is absolutely the number one thing that you can do to maintain, to stay on track to achieve your longer term lifetime and legacy goals, or the goals of the participants of the foundation or endowment or pension plan, whatever it is that you're investing for, whoever the beneficiaries in the investment program is. So just long term is key. Don't just ignore the wiggles. Don't despair, and don't get euphoric. Focus on the trend. Stocks always fluctuate in the short run. But they tend to rise in value in the long run. And I just highlight here a quote from Macbeth, actually, how we feel about these shorter term wiggles. And it's a way for, I think, the media to sell airtime to a certain extent. It's a tale full of sound and fury, and it signifies nothing when you hear the folks on the financial media and financial Twitter, et cetera, calling for doom and gloom. It generally, the world only ends once, so it can't possibly be. If you stick with the program, you're going to be okay.
Michael, you
Yeah.
Just one point on that. You bring up a very interesting concept here as it relates to just the psychology of investing in the market. And you've been investing in the markets for a long time. And one of the great quotes that I've heard in the past is it's always different every time, but the feeling is the same. And this notion of fear and angst and concern among investors is perfectly rational in periods like we're in now. Just as the feeling of excitement and euphoria when the market's going up for 3 years straight to the tune that it has over the last 3 years. But the point you're making about having a long-term plan and sticking with that plan, working with your advisor to make sure that you've got the right plan for the stage that you are in your investment time horizon is really the key in all of this. And as we'll talk about, and I think you're going to make a lot of great points through the course of the session today, it is always different every time, but this time doesn't feel all that different than a lot of the other corrections that we've seen in the past, right? I mean, nothing to be super concerned about for investors overall.
No, there was a lot of reason to be concerned heading into 2008 and 2009. and as you mentioned, I've been investing for a while. I was literally on the front lines of the great financial crisis, liquidating a non-agency residential mortgage-backed securities portfolio for UBS. So the answer is this doesn't look like that. This doesn't look like the 1970s either. So this is it's understandable in the context of what the Fed is trying to accomplish. The Fed needs to address inflation. If they don't get inflation under control, then bad decisions get made by participants in the global economy, households and businesses, and to a lesser extent governments, because you see a misallocation of resources based on prices. The most important thing to remember from that is stable prices allows for higher economic growth environments and more stable and productive activity going forward, which produces better results in capital markets. If you have an economy that's not working as well as it should, then the stock market's not going to work either. So while we're taking some short-term pain here, it's laying the foundation for a much better outcome going forward. The Fed's, we're taking the medicine right now. The Fed's delivering the medicine to regain control of prices, and in doing so, setting up both the economy and the markets for better days ahead. So just to summarize where you should be, by the way, and where we positioned ourselves and the things we were talking about in December and January this year is to get neutral weight. And in April, we changed our overall estimation of where of our risk taking, of our risk budget underweight. So now we're underweight risk overall by reducing equity market risk. In the first quarter, we reduced interest rate risk. In the second quarter now, we've we're still underweight interest rate risk, thinking that maybe the move up in rates is not done yet. But with each passing day, it appears that we may have seen the peak in interest rates, which would mean you'd want to add back some interest rate risk. But that's for the next macro and asset allocation meetings in July to determine. Always if you have the ability and the desire to gain structural risk premiums, being in alternative investments can help smooth through some of these higher volatility environments while also achieving additional alpha, because you're getting paid for things like asymmetric or complexity risk premiums, asymmetric information or complexity risk premiums. And then if you're willing to give up the money for a little while, you can gain a liquidity risk premium as well. So alternative investments remain a core focus of the investment process here, because they have such attractive features in almost any environment. So the questions we're going to try to answer today is where's the bottom, and whether or not the bond market actually is providing some value. Looking in the back or the rear view mirror, that's not the way to invest. Professional investors don't look backwards, they look forwards. And I think it's a pretty useful moment here to remind folks, with lower recent returns comes higher expected future returns. So no matter how you feel about the first 5 months of the year or 4.5 months of the year, it has been a rough ride, but it also sets up the market for higher future expected returns. So it's not time to panic and to get out. Your future expected returns go up every time the current returns go down. Doesn't make you any feel better when you're looking at the statement and it's down 15% in equities and about the same in bonds. But the truth of the matter is we should expect these fluctuations, and if you're prepared for them and you've got the right asset allocation to begin with, you should be all right. So let's jump right in. We should talk just briefly about global growth, because macroeconomic growth, both here in the United States and across the rest of the world, or ROW, is really the basis for capital market returns. If the economy is growing, and then corporate profits are growing, and if corporate profits are growing, then the equity market's going to probably do pretty well. We felt like we were at a peak last fall. So the presentation we did in November was entitled Peaks, and we moved into this new era now, at later stage of the business cycle, post peak into the late cycle, and that has implications for investment, which we're going to dig into. I'm just going to say this chart, which I like, has a lot of data on it for individual countries and going back the last 2 years, suggesting that economic activity, which was poor back in May of 2020, recovered and peaked in the summer of 2021, but we're heading back to a little more slower growth environment now here across all these economies and across these major regions, either the entire world or developed markets and EM. And looking at JP Morgan purchasing managers indices, which is a global activity index, you can see we just had a peak. We had a peak in the summer. Things are slowing down, and we should expect that because we're in the late cycle. Why are things slowing down? Because monetary policy is going in reverse. Chart on the right here is just the average global central bank interest rates or policy rates. And in the EM, it's gone from 2.5% to almost 6%. So emerging market central banks are tightening policy in order to defend their currencies, because developed market central banks are doing the same, not to the same magnitude. You've had a doubling or more of policy rates at the central banks in places like Brazil, Turkey, Russia, especially Russia. But here in the developed markets, the ECB, the Bank of Japan, Bank of England, and the Fed, we're only up 28 basis points or so, or 27 basis points from nearly zero to up 28. So all central banks around the world are raising interest rates, and you can see the number of interest rate hikes. Finally, as of last month, the number of interest rate hikes since March of 2020, right after March of 2020 in the COVID lockdown, the central bank came right to the rescue and started slashing interest rates. Both here and other global central banks slashed interest rates. You had 124 rate cuts in the last two years and a month. Now you've actually had more rate hikes. And in the last 3 months, you've had 20 times more rate hikes than you've seen rate cuts. So global monetary policy accommodation is being withdrawn. The global policy accommodation, that is central bank liquidity and quantitative easing and lowering interest rates to zero, all of those things were really supportive for both the economy and for markets. It's in reverse. So here's where most of the other countries that we kind of follow are in the business cycle. This is a business cycle which shows the early, mid, late, and recession cycles. Here's positive economic growth above the line and negative economic growth in the contraction phase, where you have a trough and a peak. And China seems to be through the trough. Russia's heading towards it. And by the way, the size of the flags represent approximately the size of the economy. So the two big ones, of course, are the US and China, but Japan is number three. So UK's here, Eurozone's here, India is doing pretty well, hasn't probably reached the peak yet, but we really moved swiftly as the US did through the recovery period. We were just here at the peak 6 or 7 months ago, and now we're rapidly moving through the late stage. And the late stage is represented by or characterized by slowing global growth, higher inflation, and tightening of monetary policy. So that's what we're seeing. Now, I'll stop there for a sec, Kevin, if there's anything interesting. Otherwise, I'm going to launch into a review of our secular forecast.
Nope, go ahead. We've got a few questions, but I think you're going to actually cover them in this next section. So
perfect. So the secular investment theme that we articulated 2 years ago now is titled financial repression. Financial repression are official policies that are pursued by the Federal Reserve and the Treasury Department in colluding with each other to keep nominal interest rates low, so that when the Treasury rolls over its mountain of debt, it can do so at agreeable and manageable levels. If interest rates just were let go wherever they were going to go, and the Fed had to, or the Treasury Department was seeing all the debt maturing, and by the way, it started in March of 2020 and April of 2020, we issued a bunch of debt to support the economy. Absolutely the right thing to do. But the debt to GDP ratio rose to the highest level in the post-World War II period. That's a huge problem. So in order to combat the negative effects of a high debt to GDP ratio, you pursue financial repression. You have the Treasury Department and the Federal Reserve get together. The Fed's going to buy the Treasury debt after it's issued and is in the secondary market. That by buying all the debt, it keeps nominal interest rates very low. Also, when the Federal Reserve buys debt, it actually pushes money into the economy. And by pushing money into the economy, that's inflationary. So the combination of those two things, low nominal interest rates and a little more inflation, drives real interest rates negative. And that's a very beneficial thing for the economy. Negative real interest rates being nominal rates minus inflation, which is the only thing that matters, by the way. If you're thinking about what you can spend 10 years from now. It's not your nominal yield. You spend your real yield adjusted for purchasing power, adjusted for inflation. So real yields are incredibly important for everybody on this call, but they don't get as much attention as they probably should. They also, negative real yields are the hallmark of financial repression. So let me just try to motivate the financial repression discussion, and then we'll move quickly into late cycle dynamics. This is debt to GDP, which is the nominal level of the national debt divided by nominal GDP. And that's what you want to do. Having a high debt level doesn't matter if you've got high income or high GDP. So normalizing your debt level for GDP for the income of the country, or for if you're a household, if you have a high debt level, but you've got high income, then again, it's not a problem. So, but when your debt exceeds your income by, in this case, 26%, the peak is 126% debt to GDP. Well, that can sometimes be a problem. The goal is to get it back below 100% of debt to GDP. And when it does, when we get below 100%, we run out of the woods, but we reduce the costs of an exogenous shock to the economy, because having a high debt level reduces your degrees of freedom to respond to economic downturns. It increases the likelihood of a currency crisis. So if we want to retain our reserve currency status as a country, and we do, this is one of the key metrics, is by maintaining your fiscal sustainability and your debt sustainability. So it was clear to us at least 2 years ago that the government was going to pursue policies of financial repression. They did it in the post-World War II period, and it was very effective. They're doing it again now. The problem is you can't pursue financial repression and fight inflation at the same time. So it was perfectly okay for the Federal Reserve to buy up the Treasury's debt, thereby lowering nominal rates, spurring the economy, pushing markets, capital markets, the stock market up. It was perfectly agreeable when inflation was very low, but inflation is now, and inflation expectations are very elevated. And I just want to suggest that maybe we're going to have to go on pause here. In fact, the Federal Reserve is going to pause financial repression policies. They're going to allow interest rates to go higher for a period of time in order to combat the outsized inflation. In a perfect world, the Fed would raise interest rates 250 basis points, inflation would go from 8% down to 2%, and that 50 basis point real yield would be enough to slow the economy and keep inflation expectations under control. And then they would reduce interest rates again. So we would be back to financial repression, but there's going to be a pause. I don't know how wide this should be, how long we're going to be on pause. It's not about time, it's about getting inflation under control. And the thing I'll say about inflation is the most important number for the Fed is longer term inflation expectations. And in fact, very specifically, a metric called the Fed 5-year forward break-even inflation. That's the market's expected inflation for the years 2027 through 2031. The Fed doesn't care much about 5-year inflation expectations. Right now, the market is saying 5-year inflation is going to be 3%. The market's also saying that the inflation from years 6 to 10, which is the 5-year forward inflation, is 2.4. They're okay with 2.4. So they're not going to have to raise interest rates 200 or 300 or 400 more basis points. They might have to raise them 150 to 200 because that's what the market expects. And if they do so, and this number stays below 2.5, we'll be out of the woods. So the Fed doesn't care about the 8% CPI number. They care about this longer term inflation expectations number. So this is what we're laser beam focused on. And I just mentioned quickly that nominal interest rates minus inflation equals the real interest rate. And this is 10-year TIPS yield. So this is the real interest rate. Just a couple of months ago, it was negative 118 basis points. If you bought a 10-year TIP and held it, you were going to have to accept a destruction of your purchasing power on the order of 1.2% per year for 10 years. So now TIPS are actually yielding a positive real yield. This is a very unusual move. This is a massive move in a short period of time, up 140 basis points from the lows. But by the way, the 118 was the lowest level since TIPS were invented in 1997. Just to put a fine point on it, negative real interest rates are not only the hallmark of financial repression, but they are the tool by which the government uses to reduce that mountain of debt. If you have negative real yields, debt to GDP goes down very quickly. It's why we were convinced that's where we were headed. And by the way, if you have a strong conviction about the macro environment, it's easier to position the portfolios to take advantage of it. So 2 years ago, we bought TIPS. 2 years ago, we bought inflation protection and hedges into the portfolio. That's what we were expecting, and those worked out. So that's financial repression. Yeah.
A couple questions that have come in, and it was relating to some of the things you were just talking about with respect to inflation. We've seen a few different numbers on inflation. You were showing those 3% numbers. We've seen some 8% numbers. Can you talk about the different types of inflation that folks might see out there and what the differences are between them?
Yeah, just quickly, the inflation numbers that get the most press are the actual inflation. It's realized inflation. The most important numbers for market participants and bond traders like myself are really inflation expectations. So there is a difference. And then within the realized inflation numbers, there's two that are really important that you're going to hear about. CPI, or Consumer Price Index, which is at 8.3%. That's the 8% number. That's the one that gets a lot of press. The Fed actually follows a different index called the Personal Consumption Expenditures Core Index. It takes out food and energy, and it also has a lower component of housing. So it's actually much lower than the CPI. The Fed number is at 5.2% plus or minus. So there's a lot of ways, there's a lot of different baskets of goods, and hence there's a lot of different price indices that you could look at. But the biggest point to remember is realized inflation is way too high for the Fed's comfort zone. Expected inflation is also elevated, but it's still longer term inflation expectations are within the range of Fed comfort, not the very high end of the Fed comfort zone. And it's that number, those numbers, that the Federal Reserve are going to focus on when deciding how high to raise interest rates or how much to take out of the Fed's balance sheet. You can tighten financial conditions and try to get a handle on inflation by either raising interest rates or reducing the size of the balance sheet. They're going to do both. And we'll talk a little bit about those components.
That's a great segue into the next section.
Yeah, so now we're in the late cycle. So it's the later stage of the business cycle. We've had the recovery, we've had the expansion. It happened very quickly because of all the fiscal and monetary policy stimulus. So here's where we are now. There's a couple of different ways we can go. The Fed would like to engineer a very rare soft landing, in which case we return to the mid-cycle, which is back here, and we have a correction or a contraction in economic activity, beyond 2023, say. The most likely outcome, unfortunately, is accelerating late cycle dynamics and a contraction sometime this year or next year, and a recession, which then begs the question, how deep and how long? And I'll try to address that in a second. This is more likely just by the very fact that the Federal Reserve has limited and very blunt tools to try to adjust cyclical economic activity. And so it's not often possible for them to basically put the brakes on and then hit the gas pedal. The economy doesn't work that way. It's been described as like a super tanker as opposed to a PT boat, and that's about right. You don't bring it. It takes an hour and a half for a super tanker once you shut the engine off to actually come to a stop. So that's kind of the analogy. So the Fed may get it wrong. They're going to do the best they can, but they may push us into a recession in an attempt to get a handle on prices, which is really more important. We actually don't really care that much if we have a short or shallow recession, if it means that we're wringing inflation's expectations out of the marketplace. That's the key. So let's keep that as in the back of our mind. A recession is not a good thing, but it actually may be the medicine that the market requires. What are the features of late cycle? You have peak economic activity, higher inflation, and when we get to the section on compensation for risk, clearly at this point you have less than you had in the past. Getting less compensation for risk, that is, the equity risk premium is lower, the yields on bonds are lower, things like that. Those are not the opportunities you're looking for to take on additional risk in a portfolio. And again, taking on additional risk is at the margin. No one should be thinking about moving their portfolios from 60-40 or 70-30 all into cash or all into equities at any point. You should just be thinking about nudging the portfolio around a little bit based on the opportunities that the market is giving you based on the compensation for risk taking. And we'll talk about that in a second. So bottom line is, when you have lower economic growth, there's an explanation for it. We expected lower economic growth because we expected that all of the fiscal stimulus that we saw in 2020 and 2021 was not only going to go away, but it was reversing. And we measure that by looking at the deficit to GDP ratio. So we have a percentage of, you're either going to be spending more money than you have, which is very stimulative, and creates a budget deficit, or you're going to have a budget surplus, or in this case, this is the difference in budget deficit spending from one year to the next. So if you have a very high, or in this case, a very low budget deficit for a couple of quarters, and then you have less of a budget deficit, that just means the government is not providing as much stimulative policies. They're not sending checks to consumers. They're not supporting businesses with lending, et cetera. All of that happened in 2020 and 2021. When that reverses, it pulls economic activity forward into the prior years. We're not going to see it in 2021. So in 2022, you knew there was going to be a slowdown just based on this factor alone. There was not going to be a Build Back Better. There was not going to be an immediate shovel-ready infrastructure plan that would get us out of this, fiscal drag situation. The change in the fiscal impulse from 2021 to 2022 is the biggest decline in fiscal stimulus since 1947, since the end of World War II. This is a big factor. But just as big, or maybe bigger, is the reduction and reversal in monetary policy accommodation. So monetary policy is tightening now. The market expects interest rates, Federal Reserve Fund interest rates, which are 75 basis points right now, to be closer to 226 basis points a year from now. So the market is expecting another 175 basis points of rate increases. Just call it 200 basis points, because that's a nice round, eight or nine interest rate hikes from now until a year from now. But the other way I mentioned that the Federal Reserve can withdraw monetary accommodation, and they're going to do this. They're going to withdraw monetary accommodation because they need to slow the economy down. The federal government is not going to spend money because they want the economy, not that the government doesn't care that much, but it's beneficial to the Fed that the economy slows down. The federal government would actually like to have boom times all the time, because that's how you get reelected as a politician. But as a Federal Reserve governor, if you had boom times all the time, you would have an inflation problem all the time too. So the independent Federal Reserve is going to raise interest rates, and they're going to reduce the size of their balance sheet. And our best guess of the size of the reduction in the Fed's balance sheet is from something on the order of 9 trillion back down to 6 trillion. And they're going to get there pretty quick based on their quantitative tightening estimates that they published after the March FOMC meeting. So it's the key to the outlook here right now is, what is the effect of quantitative tightening on financial conditions? So just remember the word financial conditions, because we're going to talk a lot about it. Here's why the Fed's reducing all of their monetary policy accommodation. And it goes to Kevin's earlier question about these different metrics of inflation that people use. These are both realized inflation metrics. These are actual year-over-year price increases on certain baskets of goods that are published by the government. One is the CPI, which is the Consumer Price Index. That's the one that's 8.3%. It's 3 standard deviations above the longer-term mean. The longer-term mean for inflation is closer to 2.25%, right? And the Fed's expected inflation target is about 2%. So CPI right now is 3 standard deviations above the 10-year average. Here's the one the Fed cares about. It's called core PCE. It's the preferred inflation measure of the Federal Reserve. It's also the highest number since the early 80s. And in fact, it was less than 1% 2 years ago in the aftermath of the COVID lockdown, and it has accelerated dramatically in the last 6 or 8 months. This is the reason the Fed is going to get on the horse and ride tightening for as long as they can. So just know, there's actual inflation. These are realized inflation numbers. The Fed cares a lot about this actual inflation number, but they care more about inflation expectations. Let's talk about the whether or not inflation. And by the way, the Fed is going to get a handle on inflation. They know how to deal with inflation. They know less about how to deal with deflation. They know everything about how to deal with inflation. And they're going to deal with inflation because they think it's persistent now. And these are some measures that suggest that some of it might be persistent. Just on the right side of this chart, you've got some what we call trim mean or sticky CPIs. It takes out the outliers. So when these numbers are really high, it suggests that inflation isn't just narrowly based. It's not just airline fares that are going up, or restaurant prices, or hotels. This is everything. So when you look at these trim mean measures and they start to jump off the charts, it means that the Fed is going to be a little more aggressive, because they're seeing a persistent and broad-based increase in prices, not just a narrow increase. And over here, this just splits out CPI between goods and services. Services CPI is starting to creep up. That's a little worrying trend. Of course, services got crushed because nobody went out nobody got on a plane, nobody went to a restaurant or a hotel. That's services inflation. And that was very subdued for a while. Whereas when everyone's staying at home and just buying stuff, as opposed to, getting a haircut, instead you were buying, goods and having delivered by Amazon, that's why goods prices went off the charts. The good news is it looks like goods price CPI, that is the prices related to goods, is rolling over. But on the other hand, the services prices look like a little more worrying trend. All in all, taken together, it seems like there is some transitory components of CPI that might go away by themselves, but there's also some persistent components that are likely to remain with us for a while. So let's talk about what the Fed can do. They're going to raise interest rates 9 times. You've got 5 additional rate hikes priced into, it's in the last 5 months at least. I mean, it's closer to 10 now. And you can raise rates a lot because, frankly, again, real interest rates matter. Taking the current Fed funds rate, which is 0.3%, that's the midpoint, and subtracting inflation gets you to a real Fed funds rate that is absolutely the lowest on record. At -5%, the real Fed funds rate is so low, the Fed can move it up a couple hundred basis points, and it won't begin to bite in terms of controlling inflation. It's why they have to raise rates, at least another 9 more times, is because real interest rates are so very low. So that's the most important thing, that they're the loosest on record. The Fed will raise rates a lot over the course of the next 90 days because they can and they should. So what is the Fed's game plan? The Fed's game plan is that they have to fight inflation and they have to reduce economic pressures to fight inflation. How do they reduce economic pressures? They raise the unemployment rate and reduce economic activity. It's as simple as that. It risks stagflation, but the way to do it is to tighten current financial conditions. And I'm going to digress for about 5 minutes here and talk about financial conditions, because it's how the Fed runs their interest rate framework. If financial conditions are tightening, then economic activity in the future will be slower and inflation will come down. So the Fed is trying to tighten financial conditions. How do they do that? The Fed tightens current financial conditions by targeting the equity market. Not specifically, they won't say that, but a reduction in equity market levels tightens financial conditions. It raises the cost of capital on corporate America. And by raising the cost of capital on corporate America, it slows investment, which slows economic growth. Increasing the uncertainty about cost of capital, which is the volatility of the S&P 500, is also another excellent way to tighten financial conditions. Widening corporate bond spreads, that also increases the cost of capital to corporate America and is a way to tighten financial conditions. The only one the Fed can control directly is by increasing interest rates, and only short-term interest rates. The other thing that tightens financial conditions is US dollar appreciation. And again, they have a little bit of effect on that, or a little control, because by raising interest rates here, the US dollar goes up or down based on our interest rates versus everybody else's interest rates. If the Federal Reserve is the only central bank raising rates, and it's not, the US dollar will appreciate. So US dollar appreciation, increased interest rates, increasing or widening corporate bond spreads, increasing the volatility of the equity market, and reducing the level. Those are all the things that the Fed are targeting. They are targeting right now in order to get inflation under control, because the way to get inflation under control is by reducing economic activity. Any thoughts, questions, or comments about that, Kevin, or is that pretty straightforward?
Yeah, well, there's a few questions related to some of the stuff that you've been talking about overall from a macro perspective. Brian was actually asking, does the Fed with their blunt instruments have the ability to distinguish between monetary price increases, aka inflation, and other causes of price increases? And related to that was a question about supply chain and the supply chain impacts on inflation and some of the pricing, and the overall economy.
I have to clarify Brian's question, and I assume he means the difference between asset price appreciation and goods prices appreciation. That is, can the Fed with their blunt tools try and deflate risk markets, like if there's an equity market bubble or something, versus directly affecting prices in the real economy, things that we buy at the grocery store, at the gas station every day? The answer is no. The blunt tool, he's right to describe it as a blunt tool. It's incapable of differentiating, and in fact, to achieve one, you have to do the other in real time. To achieve lower goods prices over time, you have to slow the economy, and to slow the economy, you have to reduce equity prices in real time. Because in the future, if equity prices go lower now, it reduces economic activity in the future. So those things are linked, and the blunt tool is actually effective only in tightening financial conditions. It is not effective in getting prices to come down on their own. The only way to get prices to come down is to take the steam out of the economy and reduce the bottlenecks associated with the demand, the high levels of demand that are causing prices to go up. You have to reduce aggregate demand. And the way you reduce aggregate demand is another way of saying you're reducing economic activity, and you do that by tightening financial conditions.
Another question that came in was related to your previous slides about interest rate increases and the number of rate increases that we expect. So you mentioned that the market expects rates to go up around 200 basis points. Is it already built into the market, or have we yet to see the change downward in the market? And I know you've got a couple slides coming up, I think, that are going to address that, right, Michael?
Yeah, we'll address it, but the answer is, yeah, right now, 10-year yields are just below 3%. And if you get 9 or 10, call it 9 rate hikes, which would of 25 basis points. Let's put it into rate hike terms. 9 25 basis point rate hikes, 10-year yields will probably stay at plus or minus 3%. If the Fed needs to raise rates 15 times, 10-year yields are going to go up another 150 basis points. They won't, because the work of the market's doing the Fed's work for it right now. So the market's got 9 interest rate hikes priced in, which again is only on the short end of the yield curve. They don't affect 10-year yields directly unless they're buying 10-year treasuries for quantitative easing, which they're not doing anymore. So the answer to the question is the Fed's going to raise interest rates. The market believes the Fed's going to raise interest rates this much, and that will reduce the damage. If this is the number, the bond market will recover. Full stop.
So effectively, it's already priced into what
already priced into the bond
Yep.
market. We've seen the destruction in the values of the bonds, and the bonds are pulling forward the expectations for Fed rate hikes. Yes.
A lot of the questions that are coming in are taking us exactly where we want to go. So let's continue on and talk a little bit about some of the wrap up on the macro and the market specifically. A lot of questions about how this all affects the equity and bond markets overall.
And they're inextricably linked. The Federal Reserve's targeting capital markets in order to slow the economy. So we'll jump right there. These are just the details of financial conditions indices that we focus on. And again, a takeaway from today's presentation might be financial conditions matter. The economy is the Fed's management of the economy is based on it. And this is what's happened to financial conditions in the last 4 months. They've tightened considerably, and in large part because the equity market. This was the close yesterday, day before yesterday. I mean, before yesterday's market debacle. So financial conditions. It's working. The Fed's doing what it wants. They're getting what they want. They talked hawkishly. They've raised rates 75 basis points. They're going to raise rates another 100 basis points, and it's causing the equity market to go down. It's causing bond spreads to widen. It's causing the US dollar to appreciate. It's working. The Fed is getting what they want. And it's important to remember that the Fed actually has both the equity market and the housing market in their sights. The housing market has had a pretty good run here in terms of up 20% plus. Some areas of the country, I was in Manhattan earlier this week, rents are up 30% or more. House prices are up 20% across the country, and in certain pockets, 30 or 40% higher. But by raising interest rates, the Fed raises mortgage rates. And by raising mortgage rates, they significantly reduce economic activity. Mortgage rates go up, mortgage applications go down. And because houses are so high, much higher in price, and because mortgage rates have jumped so much, housing affordability is off the charts low now. So housing affordability has collapsed. So you should see a slowdown in the housing market. And just bottom line, if we're going to see a slowdown, if the Fed's trying to engineer an economic slowdown, what are the probabilities of a recession? And to kind of put a fine point on it, we're looking at leading economic indicators on a heat map going back to 2020. Green is good, red is bad. So you can see we got a progression here, especially in some of the more real-time indicators that are part of the financial conditions indices. So we just talked about this: equity market volatility, stock price level, US dollar, corporate bond spreads, and interest rates. So these are all the financial conditions components, and these are all the leading indicator components, which tell you if we're headed towards an economic slowdown or not. And quite obviously, there's a lot more red here than not. The only thing that's not yet, signaling a recession is the yield curve. And that's just because the Fed hasn't raised interest rates high enough, fast enough. And jobless claims, the labor market is in great shape, but the consumer's worried. The dollar is appreciated and Fed funds are rising dramatically. So what's the likelihood of a recession? Most economists suggest it's close to 30%, which is up from 10% 6 months ago. So the probability of a recession is higher. And by the way, that's why the equity market's going down. Now, a couple of quick positive notes. What's a good argument for a short slowdown? We're going to have a slowdown. What's a good argument for either a short slowdown or a narrow or shallow recession? A short slowdown is that the consumer is in pretty good shape. Retail sales are holding up. They're down, but they're above average still. We just had a retail sales number last week. The debt service bill for the consumer is manageable, and the labor market is strong. So all of those things bode well for a short recession if we have one. The other thing that's important, and there's a lot of data here, just know this. This is the common equity tier one ratio for the four of the largest banks in the US: Wells Fargo, B of A, Citigroup, and JP Morgan. In the aftermath of the great financial crisis, all of these banks substantially improved and in many cases doubled their capital buffers. Knowing what a bank's CET1 ratio is, or common equity tier one ratio is, tells you if they're ready to withstand a financial crisis and can remain both in a positive liquidity position and remain solvent. So I do a lot of work on bank financial system metrics that suggest that the leverage in the system is lower than it was 10 years or 14 years ago, that the banks are in much stronger position than they were 14 years ago. So that would argue for a shallow slowdown. So what we would expect is, if we're going to be in a recession, if we actually get a recession as opposed to a significant slowdown, it should be short and should be shallow. Okay. Now that we're 45 minutes into the presentation, we should talk about stocks probably. So let's jump right into implications for the in late cycle dynamics. And a lot of this, we know what they are now. We were presenting some of this info, trying to prepare clients, say, look, we're heading into the late cycle. You're gonna see a couple of things that are likely to increase volatility. And the most likely reasons, many of these we could probably expect, but one of them we couldn't. We knew a Fed policy shift was coming. And with the Fed policy shift, there was going to be a compression in corporate profits because of the slowdown. Couldn't have predicted the Russia-Ukraine thing, although when they started massing tanks on the border in November, that should have been a clue, but I was taken by surprise. And China is causing a little bit of angst because of the lockdowns in Shanghai and things that are slow to taking off. So the supply chain issues related to China and their zero COVID policy are causing the market to have a little bit of angst. And we just need to have the macro picture. We need some clarity on the macro picture. It needs to improve likely before stocks stabilize. We're almost at a bear market. We're not there yet. We actually saw a minus 19.92% intraday drop. So this isn't at the market close, but peak to trough in 2022, we had a high in January, the first week of January, of 48.18 on the S&P, and the intraday low was here at 38.58, which was a drop. You need 20%. I mean, I'm pretty sure we can call that close enough for our purposes, minus 19.92. We saw actually a minus 19.8% drop, and it wasn't called a bear market in the fourth quarter of 2018. When you get to 19 and change, I mean, it's just semantics. So right now, if we go down another percent or so, or almost 2%, we would be in official bear market territory, and that would be about 38.54 on the S&P, and the S&P is trading at 39.36 right now. So volatility and the significant drawdown in the equity market is really in large part due to the fact that we're in the late cycle. The Fed is targeting financial conditions, and one of the major financial conditions they're targeting is the level of equity prices. It's also causing concern, the inflation and the fact that the Fed's tightening and raising the cost of capital on corporate America, and the cost of capital or the cost of goods and the raw materials in corporate America are also increasing. The factors of production, the prices of the factors of production are increasing. Both labor and raw materials are increasing, and that's going to put pressure on corporate profit margins. And when corporate profit margins decline, corporate earnings decline. And we're at nosebleed levels of profit margins right now. This is going back 30 years. Profit margins have been on a nice steady increase. They blew up here because of, you've got technology companies, et cetera, with high profit margins. But there's only one place to go from here, it appears, and that would be down to something closer to the trend line of the growth and profit margins. And if we just went back down to normal, thanks to Julian for this chart, you could see another 10% taken out of the equity markets pretty quickly. And in fact, we've had a couple of tape bombs recently, Target, Walmart, and 3 weeks ago, Netflix. And they're all warning based on rising input costs, which you should expect. Wages are rising, and raw materials and goods for manufacturers are rising, and finished goods are rising for retailers. So guess what? Profit margins get squeezed. When profit margins get squeezed, corporate profits get revised downward. And when corporate profits get revised downward, the equity market doesn't like it. So a couple of headlines here from the FT, the Journal, and Bloomberg, basically looking at what happened to Target, especially this is the key right here. Target and Walmart earnings sell-off puts retailers' inflation pains on display. So there's two things. Not only are input costs pressuring the expense side of the income statement, but now we're seeing higher prices starting to bite demand. So the top line is also being pressured. So this is why inflation is bad for corporations in the long run. It reduces demand because prices get too high, people stop buying things, and prices rise because the input costs are rising. Just a couple of the tape bombs we've seen. Walmart was down 18% after reporting earnings, Target down 27%, and a couple of weeks ago, Netflix was the poster child for the collapse. And most of this is inflation on the left side of the chart. This was a subscriber related issue, but the inflation, consumers are feeling the pinch. They're not spending. We're going to see a slowdown in consumption, which is the biggest part of the economy, and that's going to be reflected in Walmart and Target stock prices.
Michael, one of the things that we heard when Walmart and Target came out is they were talking about energy prices, and we've had a few questions about energy independence in the United States, and how does that impact potentially the inflationary pressures or ease in your short slowdown scenario if the U.S. were to pursue a little bit more energy independent policies?
It would take some of the pressure off. I mean, it's a supply demand thing, but it's not possible to once you mothball a rig or shut down a fracking process, it takes 60 to 90 to 120 days to come back online. Maybe some folks can do it sooner, but it takes a while. So in the meantime, the Biden administration has been basically opening up the strategic reserves to try to produce more supply. But getting more energy independent is a strategic security goal for sure, but it costs more to pull crude oil out of the ground here in the US than in Saudi Arabia, where you can just stick a stake in the ground and oil bubbles up. So the cost to extract here is higher, so you need higher oil prices to make it economical. So it's not, if oil prices stay at over $100 a barrel, you're going to see a lot of US supply come back online, but it'll take 3 to 6 months. So it'll help relieve price pressures on oil because there'll be more supply, but it doesn't happen instantaneously, and that's why we have higher prices today. The refiners and the drillers, particularly the drillers, are in the E&P side of things, exploration and production, are going to respond to the higher price because it's profitable to do that now. But then that'll push oil prices back down, which is what we want, because gas, my son filled up the gas tank in California and cost him $100, $6 a gallon, $6.50 a gallon now for gas. So it's biting. It's definitely biting. So let's talk about the equity market. We got 20 minutes. Let's talk about the equity market, and let's dig right in, because the equity market and the bond market saw some pretty crazy results in the first 4.5 months. Year to date in 2022, we've seen 18 trading days with a plus or minus 2% move. In 2020, which was a horrible year, that was the COVID year, we saw in the entire year, we saw 44. We're on pace right now because we're only 4.5 months in. We're on pace to have more 2% plus or minus trading days in 2022 than we saw in 2020. Not as many as 2008, of course, or 2009. But this is very volatile. We're moving in that direction. In terms of bigger price declines, if you're looking at minus 3.5% kind of declines, this is the plus or minus 2%. 50% of the trading days so far, over half the trading days in 2022, we've seen more than a 2% move, which is double the long-term average. The long-term average is blue. The long-term average, by the way, for a minus 3.5%, we had a minus 4% day yesterday. Minus 3.5%, you only get 1% of the time. So, only 50 of 5,000 trading days are plus or minus 3.5%. And we've already had 3 of those so far this year. 3 of the 50 are this year. So there's a heck of a lot of volatility. And again, it's due to all the factors we've described. What happens when you have such a crummy start to the year? Well, it's the worst first 4 months. It's the second worst in all time. So if you're wondering if this is an unusual occurrence, being down 17% in the first 4 months of the year, there's only been one worse year, and it was 1932. Again, it's a bit of it's a calendar specific thing. We're saying January 1st to April 30th, but nonetheless, it's pretty meaningful. On average, the worst first 4 months of the top 20 first 4 months of the year are minus 12, down minus 12. So bigger than average. What happens afterwards? On average, 12 months later, and again, I'm not actually expecting this, and certainly we're not predicting it, because frankly, every situation is different. But on average, the stock market rebounds 24% 12 months later. They can, and they do rebound. I said it earlier. When stock prices go down, when bond prices go down, it increases expected future returns, full stop. That's the only way to think about a wiggle in the stock market. You've got to focus on the trends. If the wiggles will derail you. So focus on the trend and know that when things go down, they have the capacity to go up. So after the first 4 months, the next 8 months on average, prices were up 14%, which basically gets you back to flat between now and the end of the year if the average experience holds. We don't know what's happening here, but you could have negative numbers too. A year later in 73, which was a stagflationary environment, stocks were down another 12%. In 1941, the year of the beginning of World War II, we were down after being down 10.4% in the first part of the year, down another 11.5%. So it's not guaranteed, but stocks can rebound after a bad start, and 3/4 of the time they do rebound after a pretty bad start. So I think that's important to point out. Here's another chart, by the way. This is the daily price moves for every single day in 2022. So you can see the minus 3.5s here. The minus 3.5s are boom, boom, boom. And then you can see these are minus 2% numbers here. These are plus 2% numbers here. So you can see just around, the kind of magnitude of the price changes that we've seen in 2022. Over on the right is going back 2 years. So this is on the same scale, by the way. So this is not a historic equity market vol. Back in February and March of 2020, we saw some pretty historic moves, 12% moves and 8% up, and down 6%, down 7%, up 8%. So these are the kind of moves that we saw 2 years ago. That was a historic equity market. This is a garden variety, higher volatility market. There has been this 4% yesterday was a little concerning because we don't get minus 3.5% days that much. But anyway, the volatility is again, nothing like what we saw 2 years ago. My favorite chart. It's going to take a second. So I'm asking a question. Where's the bottom? And the answer is, I don't know. But if you look at the trend in the S&P 500, which is this teal colored line here. By the way, these are all the interventions of the Federal Reserve, the green shaded areas. Going to the bottom, going back to the bottom in 2009 to the peak, which was in the first week of this year, stocks were up almost 6 times. So, and the peak was at 47.97. We're at 39.24 as of this morning. We're at 39.41 right now. That's down 18% from the peak. If we were down 20% from the peak, we'd be at 38.37. I'm just drawing a line that looks about like the post-great financial crisis trend line. Again, it's all about the trends. It's not about the wiggles. This is a huge upside wiggle, in my opinion. This is a huge downside wiggle. Everyone got pretty upset when we were down 34%. No one was saying, how I'm upset that we're up, that we're up 100% from those lows, because, everyone, it's just really, it's important to remember, if the stock market's up, everyone looks like a genius. And when it's down, everybody looks silly. But the point is, neither one of those things is true. The only genius is the one that sticks with the program and focuses on the trend. So where is the trend? The trend takes us to 38.37. I presented the same slide 3 months ago on this call, and it basically pointed to 3,800 as a potential, place where the stock market could settle. And we could go through it. We could overshoot for sure. We'd be down 30%. We'd be at 3,350, or we could be down 40%. You'd be at 2,900. But the trend will win out. The trend wins out. So even if we're down, if we get down 40%, I'm gonna, I would say let's wave in the stocks with both hands. Is what I would say. So the Fed put, which is when they come into the market and support it, the Fed put, which is a concept that bears some explanation. The Fed put is when they ease policy after a large U.S. market decline, and it made buying the dip profitable, because you knew the Fed was going to step in. If the market goes down 15 or 20%, you knew the Fed was going to start talking about supporting the market. That's the Fed put. So the Fed put doesn't exist at the same level. You have to go down much lower when inflation is so high. The Fed can support the equity market, or it can fight inflation. It can't do both. That's why we have this volatility, because the realization that the Federal Reserve is in reverse and isn't going to come in and step in and support the markets. Where is it going to go? I would like to think that most of the pain we've taken most of the pain, but there's no way to know for sure. You do know for sure that the trend will win out. I want to just highlight a chart. It's a new chart. It's our capitulation watch list. That is, before you can say with a high degree of certainty that we're at the bottom, there has to be a trade where, you finally, other people that can't stick to the plan, throw in the towel and sell stocks. And when that happens, things like the volatility index go to places like 40. We're only at 40 is the level. We're at 31 today. You can see then periods past that were really good buying opportunities. March of 2020, this is March of 2009. Basically, after the initial COVID shock, we were at 80 on the VIX index. We're only at 31 today. So no, check mark, no, it's a red check mark, no capitulation signal. The put call ratio is also a bearish signal, and it's not high enough. It needs to be at 1.25 times. It's at 0.83, it's below 1. So no capitulation. The RSI is getting there. RSI, which is the relative strength index, is actually suggests maybe we're getting to oversold conditions. Oversold is defined as a RSI of 30. We're at 36. So kind of almost there. It's yellow. Huge bearish sentiment. Average bearish sentiment of investors is close to 31%. We're 50% now. That's at a very high level. That is a signal that we may have reached capitulation. So I wouldn't say we're there yet. These are the things we're looking at. It would be absolutely silly to try to pick the bottom, but it isn't silly to try to prepare for the bottom and to try to figure out how, what kind of things we want to look at to get there. So what do we need to look at for lower equity market vol? Inflation showing signs of moderation, which means the Fed will be on pause. You see a recession indicator that suggests, maybe it's not 30%, but it's down to 20%. If the good news is when there's a lot of bad news priced in, and 30% recession probabilities is bad news. If somehow the market gets wind of a less than 30% probability, it'll stabilize and rally. The economy will rally. And then the other way that you're going to see a lack of additional drawdowns in the equity market is when it gets really cheap. When it gets super cheap, then maybe that's 14 or 15 times. We're at 17 times earnings. If we get to 15 times earnings, kind of where we were in December of 2018, that would be a signal to maybe wave in some risk or take on more additional stock exposure. So again, the macro picture needs to stabilize. The Fed is driving this train, and they're getting what they want. And it's perfectly understandable. It's painful, but it's setting the stage for higher expected returns going forward.
Michael, before we move on to bonds real quick, there's been a few questions about, in light of everything that we've said about, the Fed and the Fed targeting the equity markets and whatnot, what's the case to hold equities in a portfolio? I mean, a few questions have been, shouldn't we just be out of equities altogether?
That was a legitimate question.
There were legitimate questions that came in, which is
absolutely
exactly why I wanted you to address it.
So if you want to achieve your financial objectives, you need to earn a rate of return. And the only way to get that rate of return is in a balanced portfolio based on your own risk profile. If there's periods of time when you want to exit the market completely, then you should have a 20/80 or a 30/70 kind of portfolio. But if you want to achieve your objectives and earn a rate of return commensurate with the compensation that's available in the market, and to achieve your lifetime and legacy goals, better to be in a 50/50, 60/40, or 70/30 portfolio and stick with it. It's just not possible. There's no free lunch, and you can't exit the market. If you do, only exit the market if your liquidity profile or your risk profile has changed dramatically. That's really the best advice we could give you. Is there's no reason to exit the market unless you've got a change in your circumstances. Don't exit the market because the market is down. For a trader like myself, that's a signal to basically evaluate buy signals. That's a buy signal when things are down a lot. So just try to keep in mind that there's no way to achieve your objectives if you're out of the equity market. There's none, unless you have very low, liabilities or low expenses, et cetera. But if you do, then you should be in a 30/70 or 20/80 portfolio anyway. But most people, to achieve the goals that they have for their lives and for their families and for their endowments and foundations, need a 5 or 6% average return. So you need equities, full stop, no question. I mean, it's not even a question we want to contemplate. What we do want to contemplate is using bonds as a hedge. And unfortunately, bonds were not a hedge. The worst bond market in the world happened in 100 years has occurred in the last 4.5 months, with bonds down 9.5% to start the year. The second worst was 94, and bonds were down. I remember 94 when the Fed raised interest rates, surprisingly, in February. They raised rates and 10-year yield was at 7%. It went to 8% the next day. It was a massive rout in the bond market. So 94 was a bad year, but 2022 is 3 orders of magnitudes worse. What happens after that? A year later, on average, bonds are up 7%. We don't know what's going to happen in 2022. It's a big orange question mark here. But after 1981, bonds were down 3% to start the year, and they finished the year up 17. So bonds in particular have almost, it's not a self-correcting mechanism. That's too strong a word. Bonds have the ability to recoup their losses because when the prices go down, the running yield goes up. So we've had a historically bad bond market. And generally speaking, after a historically bad bond market, you get some pretty good, recovery. So really bad markets generally presage pretty good ones. More often than not, if you've got 3 or 4 years, 99 or 100% of the time, you're going to have a positive return in bonds. There's only been like one circumstance where you had if you had a 3-year horizon, 1% of the time, a 3-year horizon, you actually had a non-positive return. 100% of the time in bonds, if you've got a 4 or 5 year look, I mean, in 1 month, 70% of the time you're positive. 6 months, 83%. If you've got a 1-year horizon, look back, 90% of the time bonds are positive. So here's where we are in the worst 1-year bond market returns. We're right in the middle. One-year bond returns were horrible back in the 80s when rates were going up all the time. But you get set up for something. I mean, and in fact, recovery is possible and quite likely, actually. If you have a one-year bond return of one of these worst one-year bond returns, one of these years right here, the following 12 months, the bond return, total returns now, not just price returns, total returns is close to 15%, and the stock market return is close to 13%. Again, these are averages, and there's a lot of variability. Look at the standard deviation of some of these numbers. There are negative numbers. You could have negative numbers, and we are starting from very low, a historically low interest rate environment. I actually don't expect anything like these two numbers here. I'm just pointing out the averages and letting folks know there is hope, okay? After you've had a crummy year, you get a good year. Why was it so crummy? All of the negative yielding debt that we saw, not on a nominal basis, which peaked at 18 trillion. It was 9 trillion at the beginning of the year. We've squeezed out not only $2 trillion of the global ag is yielding negative. You know, there's some bonds in Germany and some in Japan and Switzerland that are yielding negative yields, but not many anymore. So this movement from negative yields to positive yields is what's caused all the damage. Here in the US, we had this massive move up in interest rates from August of 2020, which is the 230-year low of 0.5%. This is 230 years of interest rates. The low before that was 167. Now it's 51 basis points, August 4th, 2020. We're up 260 basis points from there at the peak, but it looks like it's rolled over. I'm thinking, unless something, you know, exogenous shock, that we might have seen the peak in rates at 313. So, and that would be good for the bond market. The reason interest rates have been allowed to rise so high is because the Fed is fighting inflation. That's why they have to put financial repression on pause. But I think the imperatives of financial repression remain. So the imperatives of financial repression will be, we're going to re-up on financial repression sometime in the future. This is real yields. We've talked about that. And this is a decomposition. I just want to highlight a couple of things because I made the statement that the bond market was actually starting to look a little attractive. When you can get yields, high yield muni yields, 5%, treasury yields at 3%, it's below that now. This was a week and a half ago. Oops. You can see there's value here where there wasn't before, at least on the nominal basis. If you adjust for inflation, there's also more value now, clearly more value now than there was. And yields in munis are up 1.5%. Core bond yields are up 140 basis points. I mean, yields are up a lot because prices went down a lot. So you've suffered the pain. Now you can see the results are better, you know, better returns going forward. Let's talk about compensation for risk taking, and then we'll try to wrap it up. And hopefully there's some more questions we can answer in the last 10 minutes, Steve or Kevin, if it's something we can do. Equity risk premium. So S&P 500 equity risk premium, which by the way is the earnings yield. The earnings yield is just the inverse of the PE ratio. So put some numbers on it. The earnings yield is 5%, 5% if the PE ratio is 20. The earnings yield is 4% if the PE is 25. So the use of the equity risk premium, its usefulness derives from its ability to tell you if you're getting compensated for risks that you're taking. And using the equity risk premium as a tool, it's not a timing tool, it's a valuation tool, suggests that, well, the equity, as the interest at 10-year yields rose, the equity risk premium declined. And so the compensation for taking risks declined. The low compensation for risk is down here. High compensation for risk is up here, and we're here. Okay, 2.6% on a equity risk premium is well below the 20-year average, and it's close to -1 standard deviation. Not a lot of compensation for risk taking in the equity market. This is part of the explanation. We were talking about this. We were talking about this 6 months ago. If 10-year yields rise a lot, the equity market looks a lot less attractive. So this is the proof of that. The other way to think about compensation for risk is in bonds. And the compensation for risk taking in bonds is your option adjusted spread. That is the spread over treasuries. And the option adjusted spread can be really high in cases like Feb of 2016, we had a credit spread rout. Obviously, in the aftermath of COVID, there was a spread rout. So spreads widen when default risk increases. and they tighten when default risk declines. And that's your compensation for risk taking. Compensation for risk taking in investment grade corporates has increased dramatically. There's actually there's some argument to be made that if we don't get a default wave, if we don't get a significant or severe recession, that high yield bonds may be cheap now. We're not there yet. I'm not ready to, the team at Beacon Point is not ready to say go buy high yield bonds yet, but we're close. We're a lot closer than we were when we sold all the high yield bonds out of the portfolio last summer at very tight spreads, which is what you want to do. So compensation for credit risk taking, for default risk taking is high. Interest rate risk is also, the compensation is higher because yields have gone up, and the equity market risk premium is low. Final slide. This is the positive real. All these numbers were negative. You had very low compensation for risk in municipal bonds and corporate bonds because all of these numbers were negative. All of these nominal yield numbers were much, much lower, and inflation expectations were about the same. So with nominal yields up a lot higher, you have positive real yields across the muni credit spectrum. You have positive real yields now across the corporate bond spectrum. And that's a signal that you're getting compensated for the risks that you're taking. It's how we think about the world all the time. So just to position the portfolio properly, I'll just summarize by saying we're underweight risk. We got underweight risk in April. It seems timely. That's just fortunate. The things we like are large cap value. We like private investments. We took a lot of interest rate risk out of the portfolio at the beginning of the year in anticipation of higher rates. That worked out great. We didn't have any credit risk on the portfolio. That worked out great. We took the tips trade off too early, but it worked out. It worked out great for the year and a half we had it on, but I didn't anticipate Russia. But we have other inflation protection built into the portfolio in terms of real estate, infrastructure, natural resources. And private credit provides a little bit of hedge against inflation because it's you've got floating rate debt. So I just want to finish up by saying this is the toughest time to invest, and it's the easiest time to want to throw in the towel. It's the late cycle. So if you can hang on, get down to the trough, know that better days are ahead, because the setup for higher expected future returns is the current environment, which is lower current returns. But this is how I would position a portfolio today. And with that, Kevin, I'll turn it back to you for any final questions.
Yeah, we just have a couple questions coming in that I think are really good. Touches on the crescendo here, which is so what does all this mean to a portfolio? And you talked a little bit about equity market risk, more neutral to slightly off. But if you had money to invest today, where would we recommend investing it? And a tangent to that is around the alternatives. Are there any specific areas of alternative strategies that we like more than others? For example, private credit or private equity or private real estate versus other types of alternative strategies that may be more diversified? So
the best idea we have for a portfolio today is articulated in our strategy portfolio. Our growth portfolio with select liquidity investments. So primarily private credit, private real estate, some hedged equity. It's below current risk levels. And by the way, there is a way to measure the risks that you're taking in a portfolio. And it isn't just the amount of equity exposure you have, it's the equity exposure that you have in your portfolio versus the benchmark for which your risk profile is quantified. That is, if you're a 70-30 investor, there is a benchmark for you. It's called the 70% MSCI ACWI, 30% Barclays Municipal Bond Index. Having that benchmark as our North Star, if you will, having that benchmark as the number one most important thing in mind when building a portfolio for you is the one thing that will keep you on track to achieve your lifetime and legacy goals. It's not necessary we beat the benchmark in every quarter. It's essential that we meet or beat the benchmark over longer periods of time, because those are the assumptions that are built into your financial plan. So full stop. If we're risk managing the portfolio, that is, we're building a portfolio for you that is consistent with the risk profile of the benchmark, which is equal to your risk profile, then we will increase the odds of you achieving your objective by a pretty meaningful factor. And not a lot of people are going to be talking about this to you. And not a lot of other advisors, I think, probably talk about their risk model with as much, enthusiasm and frankly pride as we do. We've got a strong risk management team headed by Julian Frazzo, who runs the portfolios that we manage through our state-of-the-art multi-factor and multi-asset risk model. And that's the key. Having strong risk management is the only way for you to achieve your objective. It's the only way for us to help you on the journey. But I would say a 70-30, any of the portfolios that we manage, first point number one, identify what your actual risk profile is, and then stick with it for the next 10 years. If you're closer to retirement, your risk profile is going to suggest a lower risk portfolio. If you're further away from retirement, or if you have longer term or indefinite liabilities like a foundation or endowment, you're going to have a higher risk profile, and you're going to have a higher equity component to your higher risk asset component, including private real estate, private equity, and real assets to hedge against inflation. And
there's been a lot of questions circling around the overall topic of, timing the market. Is it a good time to maybe build up some cash and invest, et cetera? Yeah. And I just think that one of the best kept secrets in investing that dovetails exactly with what you were just talking about is rebalancing. Because rebalancing to your strategic target allows you to do the fundamental principle of investing, which is buy low and sell high. You trim from the things that have done relatively well in your portfolio, and you're adding to things that have done relatively worse in your portfolio, so that you can take advantage of those rebounds in the cycles that you talked about, in the trends that you discussed during the course of the conversation today.
Thanks. I mean, it's important to note that material deviations from your risk profile allocations are a recipe for literally derailing your objectives. Because the only reason you want to change your asset allocation is if your liquidity needs have changed, that is, you're heading towards retirement, or the foundation or endowment needs some liquidity for a capital improvement or some kind of a capital investment, or if your risk profile has truly changed, not your risk profile in the moment, but your longer term risk profile has changed. Don't go to cash. It's an illusion of safety. Being in cash is an illusion. You will certainly destroy purchasing power in cash, and none of us have the ability to time the market at all. So as soon as you start saying the word timing, you see me kind of cringe, because it's impossible to do so. And anybody that's selling a newsletter or anything else out there that says, I've got the secret to timing, they're not going to sell it to you anyway. They're going to go sit on an island someplace and manage their own pile of money, and they're not going to reveal the secret to you. It doesn't exist. You have to talk to somebody who is actually got your best interest in mind, is a fiduciary, is only concerned with achieving a particular objective, not selling a newsletter. And that would be your financial advisor or your consultant here at Beacon Point. So identify what your objective is, build the portfolio, and then stick with it. Make sure it's risk managed like ours are. And that's the key to staying on track to achieving your objectives.
I think that's a perfect place to wrap up, Michael. So I'd like to just throw out a couple of final points around some of the different tools that we have available. If you go to our website at beaconpointe.com, you can find replays of the previous macro and markets. You can find white papers that the team from Michael's office have written. You can also find links out to our Dollars and Cents podcasts with timely information on different overall financial planning and wealth planning strategies. And you can also find Michael's quick hitting Markets in Motion podcasts, which are awesome, less than 10 minutes, very easy to digest information about timely topics that are going on in the markets in between our macro and markets call. And we'll look forward to seeing all of you on our next macro and markets call, which will be in August. So enjoy your summer. And thank you very much, Michael, for all the great information today.
Thanks, Kevin, for hosting. I appreciate you taking the time, everybody, to be on the call. Thanks so much. Look forward to speaking with you again in 3 months. Bye now.